Let me welcome the Chennai boy, Naren of ICICI Pru. Thank you very much, Naren, for joining us. In days of yore, Chennai was always seen as an FD market. People play safe, don't dabble in stocks. Has the culture changed?
No, clearly the culture kept changing. I mean, when I was studying engineering at that time, I would agree with you. And after that, between 89 and 94, I did work in both investment banking and project finance. And between 94 and 2000, I was in broking. And I had clearly seen, even at that point of time, the culture had clearly changed much more towards equities. The fact is, if you see, Chennai had the first mutual fund, private sector mutual fund.
Absolutely.
And if you see the NBFC movement also, I would say Chennai was clearly at the vanguard of the NBFC movement. If you look at even the MFI movement, I think it was south-driven. So I think when people think that, I do agree, the equity cult started from both Gujarat and the West. But otherwise, in other areas, I have seen that Chennai has certainly been involved, particularly South has been involved.
Point taken. I mean, some of the gems of the NBFC space have come from here. And even now, Shriram Transport, even some of the Cholamandalam companies would rank among the gems. And mutual fund, yes. Kothari Pioneer was the envy of every other fund manager for such a long time. Point taken. But at this point in time, you see a lot of converts into SIPs. I mean, as a fund manager, I think you guys are now wondering where to put the money, isn't it?
No, clearly, you had a situation where people were putting so much of money into property and gold between 2007 and 12. And after 12, both these markets haven't done well. And clearly, there is huge scope for financial assets to go up. And I believe mutual funds with the kind of regulatory framework and ease of investing, I guess there is huge scope for all of us.
What are the numbers you are looking at? In the last 1 year, I think there has been a rush of money. It's about ₹1 trillion that you all have got just in the last few months. What kind of money are you looking at, say, in the next 2.5 years?
See, as a firm, I guess my CEO Nimish says, you manage the money well. Don't worry how much money you will get. As long as you manage the money well.
But it becomes important, isn't it, Naren? When you have this kind of a rush for money, liquidity kind of sets the price. Markets refuse to go down. So do you think that domestic liquidity is going to provide that kind of support which pushes the bottom of the market up?
Clearly, what we as an asset management company do is also sell what we call our defensive equity products, like our Balanced Advantage Fund or Dynamic Plan, which have a fair amount of cash in their portfolios, as you can see from their monthly disclosures. So I would say that, one of the objectives, we think that equities is a very attractive asset, but not all the money should come only aggressively. It should come defensively. And we have actually spent a lot of time and energy in marketing our defensive products. So I would say that with these defensive products, we use market volatility to buy. And that is what we are hoping can ensure that the investor experience can continue to be good.
Okay. Sonia's absolutely dying to ask you questions. Sonia?
No, well, I was listening to that interesting conversation, but let me try and pipe in with some questions of my own. Naren, hi, good morning. I was just going through your list of your sectoral allocation in your funds, and it's interesting, you have been fairly cautious on the banking sector. In fact, in your dynamic plan, you've reduced your banking allocation to just about less than 18% versus more than 30% that it was a couple of years back. What makes you circumspect on banking, and how would you approach both these pockets, PSUs versus private?
See, I think this is a question we have answered. Basically, what we can clearly see is interest rates have to come down. At the same time, people believe that NPL problems can get resolved very quickly. So what we thought was, why not look at power utilities, which are bond proxies, as a good way of playing for the interest rate fall, which we've been expecting for the past quite some time. And we think that maybe that's a good way to actually invest in banking in a defensive way, is to look at bond proxies. So that is one model that we are looking at. Clearly, if you look at the NPL issue, clearly, particularly there are sectors like steel and power where the problems can't be resolved overnight. There are complex problems to be resolved, and I believe that it can take some time. So our portfolio has been defensively positioned given these problems. But in lieu of that, I would say we look at bond proxies like power utilities, which have regulated returns, which we think can fulfill what we want, lower risk but reasonable returns.
Fair enough. I was noticing that Power Grid is the top holding in both your funds. But, my question was more veering towards, if not banking, then which is the other sector that could perhaps take leadership in the next leg of this market up move? You think technology could play its part?
Clearly, technology could play its part. It did play its part for a brief period, and I think periodically you're going to get corrections in that sector because the absolute market caps are not that low. And, what we are waiting is for a cyclical recovery. Then you have an entire set of stocks which look really cheap. Because think about it, today you have very low growth in cement. You have very low growth in power demand. I mean, you have very poor margins in sectors like metals. So you know that upstream oil companies have very low margins today. So I think there's a whole set of sectors whose margins can go up significantly from where we are if you take a 3-year period. Can it happen in one quarter? I'm not too sure. But clearly, there are wide areas of the market which are very, very cheap today on price to book. Actually, today we are in a strange situation where the aggregate market caps are reasonable, but there are costly sectors and cheap sectors. And the cheap sectors seem to have bad outlook at this point of time. But you can't live without those cheap sectors also going up.
Okay, Naren, how did the mid-cap earnings look to you? I mean, it's very difficult to look for sectoral themes over there because by its very nature, it's bottom up. But the market has only seen that, as Anuj was just telling us, mid-cap's index has reached an all-time high. And the Sensex and the Nifty are still a distance away, probably 6-7% away from their all-time highs. How do you negotiate this place? If you can give us, within the constraints of your compliance, stocks that you will look at.
See, basically our view has been that mid-caps are fully valued at this point of time. Okay. And both small caps and large caps present much better opportunities. Okay. In particular, if you look at large caps, what has happened is in the March to July phase, fair amount of deleveraging has happened by the selling in stock futures. Consequent to that, many of these large caps have corrected, including quality names. And in small caps, you can go bottom up across sectors. But if you see today mid caps, there are a number of mid caps which trade at 40-50 times trailing. You can look at the cheaper ones there, but the cheaper ones there do have constraints on, I would say, near-term outlook. So, as such, if you ask me, we have bet on large caps and small caps. Not that it has worked. I think mid caps have been doing well. But I don't think, mid caps today, there are that many attractive opportunities at this point of time. Okay.
Would you dare buy the public sector man?
See, actually, we are waiting for, we believe that, the NPL issues are something which will take time to resolve. And we believe that there has to be a gradual process of accumulation, given that the NPL problems can't get resolved so quickly. So we've been cautious in that sector. We do have a few of them. And we don't think they are thumping the table buys at this point of time because of the issues involved.
What about the traditional defensives, technology and pharma stocks? Pharma stocks have not always been defensive, as we learned. Suddenly they can give you a very nasty jar.
Yeah, actually we are grappling with pharma at this point of time because one or two companies, the large cap companies, have shown pretty bad numbers. And actually, if you look at their valuation on trailing PE, you'll find that they are not cheap at all. On the other hand, you have a lot of these small cap pharma and mid cap pharma, which all have some attractive product opportunities, which gives you a lot of opportunities for growth. See, technology, on the other hand, I think is a reasonable return sector with reasonable risk. Neither is the sector expensive, neither is the outlook extremely positive because growths are not increasing substantially. So I think technology gives us a good investment from a GARP framework. It is a growth at reasonable price sector, so it fits into our investment philosophy.
Sonia?
Okay, I wanted to ask you about the oil and gas space because that too has relatively high holding in your portfolio, in your top 100 fund, about 10.3%. And as we speak, many of these oil marketing companies are hitting fresh highs. Can you break it up for us? What are you bullish on? Is it the upstream or downstream? And what do you see as the triggers from here?
See, from a value point of view, I think upstream oil is very, very cheap. On the other hand, downstream oil believes that, any drop in oil leads to increase in margins. That is not our view, because we believe that a downstream oil company has to pass the lower price to the customer. And we have been of that belief, but the market seems to believe that as prices go down, their margins will increase. Whereas that is not our view. So we are actually, I would say, negative on the downstream oil companies, because the market seems to think of them as anti-oil proxies, whereas we see them as more regulated return kind of sector at this point of time. So we are not positive on the downstream oil companies. So I think clearly the rest of the oil pack is value. Will it work in one quarter? No. Because I don't think people expected such a drastic fall in oil in the last 1 month. And therefore, today clearly you have to look at that sector with a 3-year view. And I believe some of the upstream companies cannot be given subsidy when oil is crashing below $50. So I think it has to be adjusted somewhere else. So that's why we think that the upstream oil companies neither got the benefit of oil when oil went up. So now when oil comes down also, if they're going to be hurt, then it means that the sector becomes uninvestable. So I believe that can't happen, because some of these companies are very important from a national point of view, and they will have to be given adequate resources to invest when oil is down. Otherwise, you will never create oil security in a country like India. So this is our view. We could go wrong, because finally these are sectors where what policy government decides what happens to the margins and profits in this sector.
Yeah, there is quite a bit of regulatory issues as well in this sector. But I know you won't comment on individual stocks, Naren, but I still have to ask you, one of your top holdings in your dynamic plan is Tata Motors. Although I don't want you to comment on Tata Motors as a stock, just wanted to understand your philosophy on how to approach, quality companies that go through adverse times and get derated significantly. Do you keep the faith and increase allocation there, or do you at some time, say after 10% or a 20% loss, decide to book out?
See, with a value contrarian framework, these we see as opportunities and not worries. So, what we think is when we are managing large sums of public money, for us, a setback in a stock or a sector which is temporary actually gives us an opportunity rather than we worry about it. So with that framework, we as a house, given the large public money that we manage, we look for opportunities in many of the sectors as and when there are corrections, and actually look at them for long-term investment. May not be all our strategies are focused on that. We have a few strategies which have a value contra kind of model. In those funds, clearly we look for such opportunities. So, and we have seen that over the long term, buying cheap in a sector in trouble works very, very well. And with that strategy, we look around and, doing a stop loss in a stock which we think has very good long-term potential is not our framework, unless the company is exceptionally leveraged and has a risk of bankruptcy, which certainly most of the stocks don't have.
Okay, well, I can't let you go without asking you this question, Naren. You've been talking about the kind of flows the mutual fund industry is getting. And even in a global scenario, while a lot of emerging market equities are getting bashed up because they are commodity producers, India, even if the EM basket isn't doing well, is slated to be an outperformer. Give us an idea of what kind of yearly returns you can reasonably expect at an index level. 1 year, 2 year, 3 year?
It's a very difficult question to answer. 3 months back,
that's why it's your question.
3 months back, people said that China is attractive. Let's take out money. Today, money comes to India because Brazil, Russia, Indonesia, China, Turkey, and South Africa are unattractive. Then money comes to equity because gold and property is unattractive. Money doesn't come into bonds because rates are not come down. So I believe, it's very difficult to make these assumptions. Clearly, Indian markets are not cheap. cheap. Indian markets on the aggregate are not expensive. So I think our view has been to expect for moderate returns. But if people are going to invest in India, not because of India, but because Brazil has a problem, then it's very difficult to predict the upside of the market, because the upside of the market is not being determined by India, it's determined by the downside in Brazil or Indonesia or Turkey.
Yeah, ad nauseum we are saying that we are the cleanest shirt in an otherwise dirty laundry.
Exactly.
However dirty our own stains maybe. Thank you very much, Naren, for joining us, being a Chennai boy once again, and giving us the flavor of Chennai as well. Thank you very much.